Mike Lyons was hired to fix Fiserv's biggest crisis in a decade. 9 months later, he walked away. He wasn't fired nor pushed out. He left to run a completely different bank instead. If he actually believed he could turn this around, why did he leave in the middle of it? Fiserv's stock had just gone through the kind of collapse that makes analysts reach for words like unprecedented. Two separate earnings shocks in under a year, tens of billions in market value gone, an activist investor circling, and then the guy brought in to steady the ship was gone too. That's the story most of the press condensed into a headline, and it makes sense that it stayed a headline instead of becoming a real story. Financial press covers stock moves as single dated events. Each earnings report gets its own news cycle, but the real cause here isn't one event. It's a decision made back in 2023 that didn't show up as a problem until 2025. An 18-month gap between cause and consequence is longer than any one article's attention span. Lyons didn't leave because the turnaround failed. He left for a straightforward reason, a bigger job somewhere else. But that timing points at an uncomfortable question. What broke that a new CEO couldn't fix in a year? The answer is shocking. Fiserv's flagship product, Clover, is the machine that reads your card at a coffee shop or small retailer. For years, Fiserv told investors Clover's growth was almost entirely new customers signing up, 90% new merchants, only 10% from existing customers switching over. Starting in late 2023, Fiserv moved roughly 200,000 small merchants off an older, cheaper system called PayEasy and onto Clover. Existing customers, not new ones. This is why that's hard to catch from the outside. When you move an existing customer from one platform you own to another platform you also own, that transaction volume doesn't vanish and reappear. It just moves ledgers. On Clover's books, that merchant looks like brand new growth. But investors don't get to see Clover gaining a merchant and Payeezy losing one side by side. They're reported separately, if they're broken out at all. So the number was accurate. Clover really did process that volume. However, it was still misleading because that volume already existed inside Fiserv's own business under a different name. What broke wasn't the product, it was the numbers investors were told to watch. So, if these were already Fiserv's customers, why did the numbers eventually fall apart anyway? Because the migrated merchants started leaving. Clover cost more than what they'd had before, and a lot of them didn't need the extra features. By 2025, Fiserv's own executives admitted to, quote, very significant churn. April 24th, 2025. Fiserv reported that actual transaction volume growth had slowed to 8%, down from the 14 to 17% range the year before. The stock dropped 18.5% in a single day. Then, months later, a second reckoning. Third quarter guidance got cut sharply, and the stock fell as much as 44 to 47% in a single day, a steeper one-day drop than Fiserv saw during the 2008 financial crisis. The growth wasn't fake, exactly. It just wasn't the growth investors were told it was. Once the temporary boost from migrated customers wore off, and those same customers started walking out the door, there was nothing left standing in front of the real number. Now, there's an activist investor in the room. The activist investor pushing Fiserv right now, Jana Partners, wants a full review of the company's entire portfolio and changes to its board. Whether that actually fixes anything or just buys time is still an open question. The next time you see a company's flagship product posting big growth numbers, the real question isn't whether it's growing. What's it growing against?